The top business stories live from the Sky News City studio. Have UK banks swung too far from excessive risk-taking to being overcautious? I'll speak to one of the city's top banking analysts. JD Wetherspoon targets 1,000 pubs as its half-year profits surge. I've been speaking to the founder and chairman, Sir Tim Martin. And the FTSE 100 hits its highest level for more than a year and edges closer to its all-time high. Good afternoon, this is Business Live with me, Ian King. Most people agree that the global financial crisis was, at least in part, caused by banks being undercapitalised and taking excessive risks. But what if the opposite was now the case and banks were holding too much capital and being too cautious in their lending? Well, joining me now to talk about this is Alistair Ryan. He's Head of European Banks Equity Research at Bank of America Global Research. Alistair, welcome to you. Can the banks be blamed for being overcapitalised when it's really what the regulators wanted from them?
No, for sure. It's been a huge journey. There's been about £100 billion of capital that they've raised since 2008 or retained, and about £1 trillion of cash they're now holding. And it's certainly the case that in 2008 the banks were ruinously undercapitalised, as you suggested, but trillion of cash and 100 billion of capital later, we've swung the other way. The banks are probably about as overcapitalised as they've been in 60 or 70 years.
But at least those banks are now getting a decent return on the deposits that they're holding at the Bank of England, which hasn't been the case for the last 15 years or so.
Well, that's an interesting thing. The banks are making money from their deposit business. Banking doesn't really work if you don't, because the only point of being a bank is the deposits. Anyone can lend. And they're making better profits than they've made for the last 15 years, but they're still trading below their book value. So the market doesn't feel they're making enough.
What makes you say that the banks are being too cautious in their lending?
Well, it's just as a snapshot, NatWest have given guidance, and NatWest is clearly talk of a retail share offer this year. There's a new CEO for NatWest to say that they are expecting half the bad debts that they previously guided into that environment. I think it's a remarkable statement of confidence. So just as a snapshot, the banks are saying they're really seeing nothing. Now, there's been a big series of rate hikes. There was that huge energy price shock. House prices fell, commercial property prices are down. There should have been some bad debts, surely.
Yeah, so is this because the banks are becoming better lenders?
So the banks are... It's always dangerous to say better lenders. What they've done, though, and you can see, is the quality of the average loan is much better. And they've done that through getting rid of the bad loans, but they've also done that through lending only to better people, which excludes an awful lot of people from getting a mortgage, or companies from getting a loan.
Yeah, so what sort of people are being deprived of credit as a result? Is it households? Is it businesses?
So in particular, if you take the mortgage market, there's about 1.3 million fewer mortgages now than you'd have expected under the rules a decade ago. And those are people, younger people, who wanted to borrow more than 4.5 times their income because they were expecting to get a salary rise over time. Or it's people that had a smaller deposit to put down, so it's younger people and riskier people.
Could it not be argued, though, that the reason there are fewer mortgages now is because during a period of ultra-low interest rates, a lot of people took the opportunity to overpay their mortgages and close those off?
No, it's a remarkable thing that the housing equity withdrawal from the 80s to the 2010s was a natural feature of the UK. People borrowed against the increasing value of the house, and since 2008, they've been paying back. The thing, though, is there's no new mortgages coming in the door. So there's fewer mortgages in nominal terms, in number of mortgages, than there was 15 years ago. I think is remarkable.
Yeah. Well, I mean, longer term, that means the banks are inherently less profitable because they're doing less business.
Yep, that's exactly right. So they're much less risky. They're making good profits by historical standards, but still not enough to cover what the market is telling them is the cost of capital. Well, there's less pound million of profit, but the key thing is there's just much less lending, there's much less leverage for the economy, and there's less economic growth.
And that's a key point. You would argue there are societal consequences for this. The economy is growing more slowly because the banks aren't lending as much.
Yeah, that's right. Typically, you'd expect credit to grow a bit faster than GDP. There's been no pounds of net lending from the big banks since 2008. No pounds. The economy is about 70% bigger than it was. That's just a huge deleveraging.
It's astonishing, isn't it? I mean, is this effect as pronounced in other countries as it is in the United Kingdom?
it's even more true in Ireland, where the banks were even worse back in the day. But in general, the UK is a bit more severe than Europe, is very different to the US, which has had good growth, and is completely the opposite to Asia, which has obviously been the world's economic motor this last decade.
So what needs to change then? Do the regulators need to sort of start saying to the banks, look, you don't have to sit on these huge capital cushions?
Yeah, pretty much. That extra £1 trillion of cash, that's more than they need. The capital ratios are higher than officially they need to be, and we think the regulators have been preferring those big buffers, giving the banks confidence that they're not likely to intervene, that they're comfortable with their declared targets. Yeah, that would really help.
A lot of people watching this might say, hang on, I remember the financial crisis. I remember when the banks were allowed to not hold such big capital cushions.
Yeah, so we had the riskiest banks we've ever had in 2007, right before Northern Rock fell over in an afternoon. And now we've got the least risky banks we've had in 60 or 70 years. We've also got very low economic growth, and I think the two are tightly linked. There's a balance, and we haven't been balancing, we've been de-risking.
OK, Alistair, we've got to leave it. So it's a fascinating subject. Thanks for joining me today.
Thank you.
Some other business news stories for you now. And the Competition and Markets Authority today warned the mobile operators Vodafone and Three that the proposed merger of their UK businesses is facing a full-blown investigation. The CMA said it was worried that the deal, which would bring together the UK's third and fourth largest mobile players to create a new market leader, could result in mobile customers facing higher prices and reduced quality. It's given the pair 5 working days to come up with meaningful solutions to its concerns, or it will press ahead with the investigation. Shares of Phoenix Group jumped by as much as 9% today after it said it had hit its 2025 targets 2 years early. The UK's biggest long-term savings and retirement business, which has more than 14 million customers, was reporting an adjusted operating profit of £670 million for 2023. That was up 13% on 2022 and better than expected. Well, Phoenix, which owns the Standard Life brand and which runs the policies of former customers of businesses including Pearl, Britannic and Abbey Life, also announced new targets, including one to generate £1.4 billion worth of cash in 2026. The pub operator JD Wetherspoon said today it has potential for about 1,000 pubs in the UK. Well, that would represent a significant increase from the 814 pubs from which it was trading at the end of January. Wetherspoon today reported a pre-tax profit of £36 million for the 6 months to the 28th of January. That was up from £4.6 million in the same period a year earlier. The shares have slipped on news that like-for-like sales growth since then has been 5.8%, down from 9.9% during the reporting period. Well, earlier I spoke to Sir Tim Martin, the founder and chairman of JD Wetherspoon, about those expansion plans.
It's quite quick going from 500 to 800, but it's slower filling in the final gaps. So I don't want to put too much of a timescale on it, but probably not much more than a dozen a year, and a substantial investment in enlarging existing pubs as well is what we're up to these days.
Donald Trump's social media businesses took another step today towards floating on the stock market. Shareholders of Digital World Acquisition Corp, a special-purpose acquisition company or so-called blank cheque company, agreed today to merge it with the former US president's Trump Media and Technology Group, whose flagship product is the social networking site Truth Social. The renamed business will list on NASDAQ next week. Shares of Digital World Acquisition Corp have fallen by as much as 9% this afternoon. The UK's leading independent supplier of tissue paper, toilet roll and kitchen roll has agreed to a takeover, valuing it at £127.5 million. Accrol, which is based in Blackburn and which was founded 31 years ago, is being bought by the Portuguese company Navigator. Well, Accrol, whose brands include Softy facial tissue, Elegance toilet tissue and wipes and Magnum kitchen roll, said it would benefit from being part of a larger business. It said its share price had been weak since 2018, despite a significant turnaround in the business, which would make it difficult to fund future expansion by issuing new shares. Aston Martin Lagonda has raided Bentley Motors for its new chief executive. Adrian Hallmark, who's been chief executive of Bentley since 2018, will succeed Amedeo Felisa at some point before the beginning of October. Well, Mr Hallmark is credited with overseeing a turnaround at Bentley, which has seen profits rise tenfold in the last 5 years. He will be Aston Martin's third chief executive in 4 years. Well, shares of Aston Martin are up 1% on that news. And Sky News has learnt that the chairman of the Land Registry is being considered by ministers to be the next chairman of the Post Office. Neil Sachdev is among a small number of final candidates to become the interim chair, replacing Henry Staunton, who was sacked last month. The government is believed to be keen to finalise the appointment, with the Post Office mired in controversy over compensation for wrongly convicted former sub-postmasters. Now, yesterday saw confirmation that Nationwide Building Society is to buy Virgin Money for £2.9 billion. The deal will take Nationwide into business banking for the first time and cement its position as the UK's second biggest mortgage provider after Lloyds Banking Group, the parent, of course, of Halifax. But the deal has raised questions about the future for Britain's so-called challenger banks. Well, joining me now to talk about this is Lucinda Guthrie. She's head of Merger Market. Lucinda, welcome to you. Before we talk about the sectoral implications, there's been a lot of commentary about whether Nationwide should have put this to a vote of its members. What do you think?
Well, my personal view is that you have to follow the UK Takeover Code rules. So that's why it's not happening. And that was, indeed, it would have been the biggest potential risk to this transaction. So I think they've got away really lightly not being able to do it.
Well, they have. I mean, this is a Class A transaction. If they were a PLC, they would have had to put this to a vote of shareholders.
Absolutely. So, I mean, I think there is question whether that can build, but they don't have to, and I think they've got away with it.
Interesting. Now, where does this leave the challenger banks? I mean, if you think back a few years ago, there was Virgin Money, TSB, Metro Bank, all being talked about, big rivals to the big four. It just hasn't happened.
No, exactly. I mean, the interesting thing about this transaction, right, this is the largest UK banking transaction since the financial crisis, according to our data. Now, we just mentioned Virgin Money was set up to be this challenger bank to the incumbents, and what they're doing is they're merging for scale, right? So we had these banks that were meant to be these more nimble players, and now, because of the capital requirements that you were just talking to Alistair about, you have to have scale to survive. And I think that, as you say, there's a question mark over that model. What's going to happen to the remaining challenger banks? Are they going to have to scale up? Yeah. Or, you know, what is their future?
Do they just get subsumed into the big four? I mean,
exactly.
Would the competition watchdogs allow further consolidation in the sector?
Well, I actually think we need to watch just the Nationwide deal, just there, right? This is an election year. You're talking about mortgages, something that makes an impact in everyone's pocket, right? So the CMA may think, you know, if you look at a market share, just the market share on its own, you might think, oh, that doesn't raise eyebrows. But this changes the whole dynamic of the industry. And they've always looked at mavericks. I'm not saying that Virgin Money was a maverick, but they have always looked at these sort of different players in the ecosystem. So I'm not saying that this is a huge risk for the transaction, but I think if I were at the CMA, I might like to take a look.
Yeah, particularly given that they seem more interventionist these days. I mean, what's really quite depressing about this is that Virgin Money, it kind of feels like they've thrown in the towel. It's a recognition that they didn't have the size or scale to take on the big four.
Well, exactly. I think that's it, and I think part of this is around those capital requirements, the funding requirements, the funding pressures. And I think that's why, ultimately, shareholders are getting a pretty good premium for this. And many people think that Virgin Money was one of the best of the challenger banks. Yeah. So if the best one's getting taken out...
Now, what about business banking in particular? How do you rate Nationwide's chances of breaking into the big four there? Because, I mean, Santander, who are a much, much bigger business, have been trying it for years, and they really haven't got that far.
Well, they haven't, and I know Debbie Crosby's been very keen on business banking for some time, so this transaction gives her a significant book of business, and they want to take Nationwide's values there into that space. So I say best of luck, and I think this is probably the best shot they'll get at it.
Yeah, I mean, it's difficult for them to sort of parlay their existing business into business banking because they're coming at it completely fresh. I mean, at least Santander had an existing base to build on.
Yeah, you're right. So, I mean, it is a new market, but it's something I think that hasn't been... It's not going into lightly. You know, I think it's very well thought out, and that's... Hopefully, as I say, I wish them the best of luck.
Yeah, absolutely, Lucinda. Great to see you this afternoon. And if anyone from Nationwide is watching, Debbie, we talked on this programme before. We'd love to have you back to talk about this deal. Still to come here on Business Live. We'll have a look at how the markets have finished the week. Stay with us.
It's a really exciting day for us because we've got a new young pair of snow leopards into the zoo. We really haven't had such a threatened and such an iconic species like this for many, many years here at the zoo. So the two have joined us, young male, young female, both just under 2 years old, and really are going to be the foundation of our breeding program moving forwards here. So it's really exciting for us. They're settling in slowly. We've had to be very careful and quiet about settling them down. Once they settle down, they themselves are not too difficult a species to look after. Their needs are fairly simple. They're very hardy. I mean, where they come from in Central Asia, they're used to the most extreme and inclement of weather. So settling them down, feeding them and so on, and the daily care is not too complicated compared to some animals we work with here. But actually, the habitat we've built for them will help that tremendously because it's a superb habitat that we've created for them here at Chester Zoo. The colour is just exquisite. So they have this most amazing camouflage. I think you might be able to see one of them just settled and asleep behind me. But they have this most exquisite colour that's designed to make them just blend and disappear in sort of Himalayan mountain, a patchwork of snow and rocks. But they're much smaller, much lighter, and they even feed right down to feeding on very small voles and squirrels at times. So they live in a much harsher environment as a result of much smaller, much lighter, and extremely agile, I should say. For them, jumping sort of 12, 14 feet is nothing. At the moment, because they're so threatened, it's just really important that we settle them down. They're still a bit young, and so they normally wouldn't mature until they're between sort of 2 and 3 years old. So we're probably going to have a good year or so while they mature, get used to each other. They're still separated at the moment. We've still got that introduction to go. And then who knows, perhaps looking at 2025, maybe 2026 for the first breeding. And then that really will be a landmark.
Traveling is not just about the destination. It's also about how you get there. Fly Emirates, fly better. Fly Emirates, fly better.
Well, the pound has continued to drift lower on foreign exchange markets following the Bank of England's dovish tilt yesterday. Here's the current picture. Sterling currently off by just under 0.5% against the US dollar. It's actually trading at its lowest level against the greenback since the 16th of February. More or less unchanged against the euro, although it's hit its lowest level today against the euro since the 17th of January. On the equity markets, here's how stocks in Europe have finished this afternoon. Only the CAC 40 in Paris letting the side down there. It's been pretty mixed, as I say. Talking points today include Galderma, the Swiss provider of medical creams, has surged by some 18% on its stock market debut. Here in London, well, the FTSE 100 is up on largely gains for some of the big dollar earners, and it's now less than 1.5% below its all-time high. The leading gainer in the index in percentage terms today, I mentioned them earlier in the programme, Phoenix Group, the life company, currently up 8.5% at the close there. Pretty strong performance from them today. To the downside, JD Sports has finished some 6.25% lower. That's on a warning from Nike of falling sales in the first half of the financial year. Outside the FTSE 100, Sir Martin Sorrell's S4 Capital is up 3.5% on a report in the Wall Street Journal that it's rejected several takeover approaches. But the cybersecurity firm Darktrace is down 8% after a fund advised by the private equity giant KKR offloaded its entire 2.5% stake. Over on Wall Street, the S&P 500 has opened to the downside. Nasdaq also now in negative territory. It did open the higher very briefly, though both on course, it should be said, for their best weekly gains this year. I mentioned Nike, well, they've fallen 7% on that sales warning, while FedEx has risen by 7.5% as its quarterly results beat expectations. As for the oil price, very interesting week it's had, really. Up very sharply on Monday and Tuesday. It's given all of those gains back over the last 3 days. Barrel of Brent crude currently changing hands at $85.40 a barrel. That's off a little over 0.2%. Well, joining me now is our old mate Neil Wilson. He's Chief Market Analyst at Finalto and Markets.com. Neil, good to see you today. Big week for macro, obviously. Lots of news out of the central banks. No change either side of the Atlantic, and yet the S&P's at a record level, the Nasdaq is, and the FTSE's knocking on the door of its all-time high.
Yeah, it's great. It's a roaring 20s trade, I guess you might call it. You know, it's the sense that central banks are going to, you know, they're going to be on side, if you like. They're going to maintain the liquidity. They're going to cut interest rates. And there had been some fears that maybe the Fed would sound a little bit more, you know, a little bit more cautious about cutting rates because inflation in the US has been quite sticky. But they stuck to that forecast that they're going to cut interest rates 3 times this year. Markets now fully pricing in 3 cuts by the Bank of England this year as well. So definitely a sense that the central banks are on side, that essentially they're not going to go that last mile. There's been a lot of chatter about the last mile on inflation being the toughest, that would be the hardest bit. And I think there's a sense this week that, you know, at last they're sort of saying, well, we're not going to bother with that last mile. We're not going to, you know, kill ourselves trying to get that last mile. We're going to accept that inflation will be structurally a bit higher, you know, maybe not 2%, but more like 3 to 4%. And that is, after all, what they've been aiming at since 2008. You know, they've been trying desperately to generate inflation, and you know, they're quite keen to bump it along at that level. They're happy with that. They want to keep the economy, you know, the economy growing. They want jobs to keep being created, and you know, slightly higher inflation with lower rates is good for the debt burden in the US and the UK. So it's all kind of, you know, as we might expect, but it has definitely helped to boost risk appetite because you know, when the central banks are on side, that does do wonders for risk sentiment.
Neil, if you look at the FTSE 100 in particular, though, is the kind of increase that we've seen this year underpinned at all by fundamentals? I mean, company earnings have been a bit all over the place, really. Some good, some not so good over the first few months of the year.
Yeah, I mean, well, I would say that the FTSE is, you know, it's catching up. I mean, we've had record highs on, you know, across Europe, the stock 600, the DAX, the CAC, record highs in Japan, record highs in India, record highs in the US, and really, there's no particular reason why the UK should be trading at such a discount to peers. I mean, there's been well trodden turf that particular argument around, you know, whether it's to do with LDI, whether it's to do with stamp duty, all these things, and the amount of pension funds invest in the UK. But you know, there's no essential reason why the UK should trade at such a discount. Although it is, you know, maybe it should trade at a discount because it's less profitable. But you know, the UK is catching up, but FTSE's catching up. I think maybe a bit of pound weakness this week has you know, maybe helped a touch, but the oil price has come off as well. So I think it's maybe a bit of a realization that the FTSE was trading, you know, the UK was trading at probably just too much of a discount, and that some kind of rebalancing was in order.
OK, Neil, we have to leave it there. Good to see you as ever this afternoon. Have a great weekend. Thank you. That's it from me. I'm back again on Monday morning at 11:30 with the next edition of Business Live. In the meantime, coming up next, it's the News Hour with Jonathan Samuels. Do stay tuned for that. Have a great weekend, everyone, and thanks for joining me today. Cheerio.